It's Wednesday, the 31st of May, 2023. Welcome to the Fast Five by Fear and Greed, where we give you the top 5 business stories you need to know in just 5 minutes. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, 5 stories in 5 minutes. Let's jump into it. Story number 1 is an absolute cracker. Qantas is on track to fly Sydney to London non-stop. That's a 19-hour journey. That's in 2025 it's expected to take place, and the ultra-long haul flights are tipped to be very, very lucrative for the airline.
In fact, the national carrier reckons in the first full year that it's flying non-stop East Coast to London and New York, earnings will benefit by about $400 million. Now, that's not much more than what all the international routes contribute right now. Qantas says it hopes to have 12 new Airbus A350 jets flying the routes by 2030. Chief Executive Alan Joyce said the new aircraft have started arriving and they'll transform the carrier's network. Now, analysts reckon Qantas's fleet renewal project will cost up to $15 billion over the next 5 years and involve nearly 300 new aircraft. They include both Airbus and Boeing varieties. Qantas is promising they'll be more comfortable, less noisy, and with fewer carbon emissions. Also yesterday, Michael, they said that the Qantas loyalty business should deliver up to $1 billion in earnings by 2030. Pretty amazing.
Yeah, sure is. And that all sounds good, from, say, an investor viewpoint. But what about me, Sean? What about the customers of Qantas?
Well, yesterday was all about the long-term strategy, but they had a few announcements. There'll be changes to the boarding processes from November this year, like occurs at many overseas airports. People will have to board in sections. Also, the Qantas app will be overhauled. You'll be able to track to see if your luggage is on the plane with you. Not sure that you actually want to know that if it's not on the plane. And Qantas also plans to expand the current range of redemption options for frequent flyers. The national carrier is promising continued investment in low fares.
Right. Story number 2, Sean. The building sector is in a slump, with approvals for new dwellings down 24% compared to a year ago. That is big.
Yeah, bad news for construction companies, builders and tradies, and bad news for the economy because construction has a big flow-on effect to the rest of the economy. Someone builds a house, they need to fill it with stuff, furniture, TVs, fridges, etc. Has this economic multiplier effect. It's very large in construction. But last month, building approvals fell by 8% according to the Bureau of Statistics. Hardest hit has been apartment buildings, and given the influx of international students expected in coming years, that's really bad news for renters. Mostly it's been because of interest rates rising, cost blowouts, and it's been very hard for builders to find labour. Chronic underbuilding is emerging as a real problem for the economy.
Story number 3, Sean. The boss of Wesfarmers, Rob Scott, believes the glory days of government largesse, low interest rates and good times for companies, including retailers, is well and truly over. We're moving into what he calls the big squeeze.
Wesfarmers is Australia's 10th largest company, and apart from Bunnings, Officeworks and Kmart, it also runs a chemical business and it's looking at health and lithium. At yesterday's Investor Day, Scott said the honeymoon is over for many retailers. Shoppers are trading down to cheaper products, which actually helps Wesfarmers, and he says value will become even more important to customers. Businesses also face an escalation in wage pressures and a post-COVID drop in productivity, hence the big squeeze. Bunnings is the powerhouse of Wesfarmers retailers. It's thinking about pushing more into pets and pet care, more into the power tools business. Also yesterday, Scott said Wesfarmers won't make a higher bid for Silk Laser, the Botox Group. Another bid came over the top of them last week, and they're going to let the Hong Kong-based suitor have it.
Sean, story number 4, you might have to talk me through this one because Australian customers of Binance are so desperate to quit the Dubai-based crypto exchange that they're willing to accept $6,000 per unit less to liquidate their Bitcoin.
So if you were selling a unit of Bitcoin yesterday on Binance, you were selling it at $36,000. On the other exchanges, it was about $42,000. Why? Because as of today, Binance will stop facilitating all Australian dollar withdrawals. That's because its banking partner, Cuscal, wound down the partnership. Some of the major banks don't want to deal with Binance. It's having all sorts of issues. Binance has told its 1 million Australian customers that anything left on its books after today will be converted into another type of cryptocurrency, USDT, which is pegged to the US dollar. Total mess, Michael.
Yeah, makes sense, but it is ugly. Story number 5, Sean. I really don't know what to expect today because we've had a bit of a focus on unusual stories for story number 5 over the last couple of days. We had the Indian food inspector who drained a dam to look for his phone. We had the nun from Missouri who was exhumed 4 years after her burial and was completely intact. What have you got?
Well, I think we should focus a little bit more on business. So today's offering is the chief executive of Philip Morris International, saying the company, which makes Marlboro cigarettes, of course, is on its way to becoming an ESG stock. Environmental, social and governance investors put their money into things that improve the world. Energy transformation, for example. They shy away fervently from things that harm the world, companies that make weapons, and yes, cigarettes. Last year, Philip Morris sold 621 billion cigarettes worldwide, and cigarettes are the leading cause of preventable deaths globally. Philip Morris boss, Jakob Olzak, pointed to the fact that because the company now makes less harmful nicotine alternatives, like vapes, maybe it's on the way to being ESG friendly. When asked by the Financial Times if one day the company might be classified as an ESG stock because of its push away from cigarettes, he said, I think so. Even he didn't sound convinced, Michael.
Yeah, it sounds like a little bit of an overreach to me, Sean. There we go. The top 5 business stories in 5 minutes. Thank you very much.
Thank you, Michael.
It's Wednesday, the 31st of May, 2023. Remember to hit follow on the podcast. If 5 minutes isn't enough, you can find our longer daily show called Fear and Greed wherever you listen to podcasts. I'm Michael Thompson, and that was the Fast 5 by Fear and Greed. Have a great day.